So let's imagine that you have several different types of accounts. You have maybe a tax-deferred, or what we sometimes call traditional retirement account. Maybe you have some Roth accounts, and then of course there's taxable accounts. Maybe you have all three or two of them. And the question comes up, well, we're familiar with the 4% rule, and if you've watched this channel for a long time, you know of a lot of other withdrawal strategies, but we'll stick with the 4% rule. Does it apply in the same way to each of those account types? After all, we're going to owe taxes on some of them, a lot on tax-deferred accounts, some amount on taxable accounts, nothing on Roth accounts. And so shouldn't we think about the 4% rule in a different way depending on the account type? Well, that's the question we're going to cover in today's video. And it came up in an email from a viewer. Let me read it to you. His name is Gary. He says, okay, 4% is the sustainable spending limit. He says, but 95% of my savings are in IRAs. And when I start RMDs in a year, what will be my sustainable spending limit? He points out that he's going to, of course, give a lot of money for state and federal taxes. If he withdraws 4% and pays the taxes from that amount, since so much of his money is in a traditional IRA, it's going to leave him with about 2.6%. So he's wanting to know, do I take out another 3% and then pay taxes on that, but have enough left over to pay the taxes on the first withdrawal, or am I just sort of stuck with 2.6%? And he also asks, does NewRetirement, which is a financial planning software sort of tool that I use to plan our retirement, does NewRetirement account for all of this? How does it work? So here's what we're going to do in today's video. First, we're going to talk a minute about how Bill Bengen actually addressed this issue. He didn't address it in his famous 1994 paper that gave us the 4% rule, but he did address it in the 1996 paper and then again in the 1997 paper. We'll look at those. I'll leave links to both of them below the video if you really want to dive into the weeds. And then I'll give you how I deal with it and view it, which is, by the way, very, very different than how Bill Bengen does. Of course, you'll decide for yourself which one makes the most sense for you. And then we'll look at a more practical level, and that is just how does a tool like NewRetirement deal with this issue? So that's what we're going to do. And let's dive in. So I want to first show you Bill Bengen's 1996 paper. So remember, he wrote what gave us the 4% rule paper in 1994. And this one, we'll just go to the top for a second. Asset allocation for a lifetime. This was sort of a follow-up paper where he answered a bunch of different questions from hypothetical clients about the 4% rule. And one of them was this question, not unlike the question I just read you, about different account types. Now, in his 1994 paper, Bill Bengen assumed tax-deferred accounts and kind of basically ignored taxes. In this question, now remember, this is written in the 1990s. Tax laws were very different. I don't think at this point Roth IRAs were available, so you have to keep that in mind. So he has a section here right there on taxable portfolios. And he talks a bit about, in this sort of hypothetical conversation with a client named Wendy, different issues that you confront with a taxable account. But here's what he ultimately decided. He said, look, your withdrawal rate, your sustainable initial withdrawal rate is actually different for taxable accounts than it is for tax-deferred accounts. Now, the question for you is, did he say your sustainable withdrawal rate is higher than 4% with taxable accounts or lower? Well, I'll show you that in just a second. But when I first puzzled through that question, I thought, well, I guess it would be higher, right? Because your tax liability is lower. With a tax-deferred account, you're taxed at ordinary income rates, and every dollar you take out gets counted towards ordinary income. With taxable accounts, you get the benefit of long-term capital gains. By the way, that benefit wasn't nearly as great in the 1990s as it is today. But you also don't pay taxes on everything. You only pay taxes on the gains. So yeah, for taxable accounts, the sustainable withdrawal rate should be higher, right? Well, not according to Bill Bengen. Let me show you the chart he uses. Here it is. It's on, I guess, the 5th page of this article. And this is the chart. So this tax-deferred line is, let me try to make it a bit bigger for you maybe. There we go. That's, from a tax-deferred account similar to his 1994 paper. And you can see the allocations here. So he starts with a 40% stock allocation in this first vertical line all the way up to 100%. You recall he views 50 to 75% as sort of the sweet spot. In this case, 55% is right here. And for a tax-deferred account, it gets you a sustainable rate of about 4.1%, consistent with his 94 paper. In a taxable account, though, assuming a 20% tax rate, it drops to roughly 3.8. But boy, at a 35% tax rate, again, these are 1990 taxes, goes below 3.6, closer to 3.5, and it gets even lower at that particular asset allocation, gets even lower at a 45% tax rate. And the question becomes, well, why? And the answer is, I have no earthly idea. I have read that paper, I can't tell you how many times, and I just don't understand why he changes the withdrawal rate based on taxable accounts versus a tax-deferred account. And frankly, it's not explained very well, at least that I can understand, in that 1996 paper. Now, you may be able to read it and make sense of it. Maybe you can leave a comment below this video and explain it to us. Now, does the 1997 paper maybe clear things up? Well, you know the answer is no, but I'll show it to you anyway. Here it is. And another section on taxable accounts, he actually talks about some calculation errors that he identified in his 1996 paper, which he corrects. Frankly, not all that relevant for our purposes. What I want to focus on is this paragraph right here. He says, in general, at a 35% tax rate, taxable portfolios have safe withdrawal rates that are about 20% less than for tax-deferred portfolios of the same longevity. Why? I have no earthly idea. And again, in his 1997 paper, he doesn't explain why, at least that I can understand. He then goes on, because the portfolio is assumed to pay all taxes on investment income generated by the portfolio, well, okay, fine. This still gives the taxable portfolio the edge on after-tax withdrawals when compared with a tax-deferred portfolio of identical size. Again, that sentence doesn't make any sense to me. I certainly understand why a taxable portfolio, you're going to pay less in taxes than a tax-deferred account. And so for that reason alone, you'd have more money left over after taxes. But beyond that, I can tell you I've read that paragraph dozens of times, and I think each time I read it, I understand it less. Again, maybe you're smarter than I am and you can figure it out and you can explain it all to us in the comments below this video. The good news is, I think there's a much simpler way to understand all of this, and I'll at least give you my approach. I don't view the safe withdrawal rate, and this is true whether you're talking about the 4% rule, that's what we're using today, but you could use any other withdrawal strategy. I don't view them as any different based on the different account types. It's just math. If based on historical returns and inflation, you can take out, we'll just assume the number is 4%. That requires a whole host of assumptions, right? What your asset allocation is specifically the asset classes you're using, the years you're going to look at from an historical perspective, but fine. Let's just assume 4%. I don't think it's any different based on the account type. The math isn't going to change. It is true, once you pull it out of a specific account type, that may or may not trigger taxes. It won't if it's a Roth. It will if it's a tax-deferred account for sure, and likely also if it's a taxable account but in a different amount, so that when you pull that money out, some of it will have to go to Uncle Sam and for state income tax, depending on where you live. That's certainly true. Just like some of it's probably going to go to the grocery store and to utilities and maybe a car payment. Yes, some of it will have to go for taxes, depending on the account type. But why does that change the safe withdrawal rate? I think all that changes is how we have to use that money. It doesn't actually change the safe withdrawal rate. And in fact, trying to calculate some after-tax safe withdrawal rate, first of all, I think is enormously complicated, in part, by the way, because all of our tax situations are different, and also just totally unnecessary. I don't see how it helps us. It's certainly true, as we saw in the email from Gary, that as we're thinking about our planning, we have to factor in taxes. So if we're going to take out 4% of an IRA, we do know that that is going to trigger some taxes that we have to account for. One way to think about this, and then we'll get to NewRetirement, is to say, okay, let's just assume $40,000 after taxes. If it's going to come from an IRA, then you know that pulling that money out is going to trigger some amount of tax liability, not too difficult to figure out what it is. And in retirement, for most of the people, I think most of the time, your situation is going to be pretty similar from year to year in terms of spending and tax liability. You're going to have some idea of what it is. Let's just assume it's $10,000 so that you have to take out 50 grand. You pay $10,000 in taxes, that leaves you $40,000. It's pretty straightforward. Now, whether taking out $50,000 is sustainable depends on how much money you have to begin with. So that's where we take that $50,000, which includes taxes in this case because we're dealing with a tax-deferred account, and we compare it to our total savings to understand how does it compare, in this case, to the 4% rule. Now, does it get a little more complicated when we start pulling from multiple accounts within the same year? Yeah, a little bit, sure. Of course, with a Roth account, it's simple. You're not going to pay any taxes. But at some point, you may be taking from all three account types. You'll have some rough idea of what those taxes will be as a result of taking from that account or those accounts. And you can then compare it to your total savings to see how it compares, in this case, to the 4% rule. It's not really that complicated. Now, having said all of that, this is where NewRetirement and other, by the way, financial planning tools really shine and really make this process much, much easier. But they do it in a way that's different. They don't typically start with some withdrawal strategy like the 4% rule. So here's how NewRetirement does it. We can walk through it very quickly. In NewRetirement, you're going to, of course, list all of your investments by account type. So NewRetirement's going to know you have so much in tax-deferred accounts, Roth accounts, and taxable accounts. You're going to input your expenses each year. You can do it as just one number, or you can actually itemize it in the budgeting tool and break it down that way. But NewRetirement's going to know, okay, you spend whatever that amount of money is each year. And it's going to then pull from your accounts. And they have a certain order that they do it in, and you can change that order. But the sort of default order is taxable accounts first, then tax deferred, and then Roth. Again, you can change that order, but that's sort of the default order of operations, they call it. So they're going to pull from those account types to enough money to cover the expenses you've entered in that tool, your annual budget. And what they're going to do is calculate the taxes for you. So they're going to calculate your state income tax based on where you live, your federal income tax, including capital gains tax. Let's say if you're pulling from a taxable account, they're going to calculate that for you as part of the financial planning tool. And then based on all of that analysis throughout your projected lifetime, because you set an end of life year in the tool, it will tell you, based on all of the assumptions you've entered, including the expected returns on your investments and your anticipation of inflation and all these other assumptions, which of course you can change, your chance of success. They will run a Monte Carlo simulation that looks at, in some cases, 500, I believe, in other cases, 1,000 different simulations to tell you, okay, 92% of the time, this plan will work. There's an 8% chance you may have to make a modification to it, or maybe your chance of success is lower. And of course, you can compare different scenarios and different plans. Perhaps in one case, you spend a little more money, or in another scenario, you work an extra year. Or in a third scenario, you change when you claim Social Security. So you can create all of these alternative scenarios and compare them to each other to see what the chance of success is, how much you can spend each year, what your net worth is at end of life, particularly if estate planning and inheritance are an important goal for you. So you can do all of these things in NewRetirement, and the beauty of it is it sort of just does all the calculations for you, including all of the state and federal income tax and capital gains taxes that you might owe. So that's how NewRetirement does it. And I think it's fairly straightforward. There's a lot of moving parts to it, and it does take some time to learn that software. I think that's generally true with any financial planning software. But once you do, it's fairly straightforward on how to work it. Again, from a theoretical perspective, I see no reason to view the safe withdrawal rate any differently between a Roth, a tax-deferred, or taxable account. I think it's the same for all. Certainly, the math behind the 4% rule doesn't care how you or I actually spend the money we take out. And depending on the account type, yeah, we're going to have to spend some of it on taxes. But at the end of the day, the math is still the math. It comes out and works out the same way. So that's my take on it. Hopefully you found this helpful. Again, I'll link to the Bill Bengen articles below as well as NewRetirement. And yeah, if anyone can explain his thinking from those 96 and 97 papers, please leave a comment below this video. And until next time, remember, the best thing money can buy is financial freedom.